Well, as we walk into trade this morning, US markets are shut, and if I'll really look at local cues, we are off to a good start in the month of July. Uh, this just could be largely because of the fact that June was very bad, and the quarter which we put behind us was in a sense a dark quarter for emerging markets and for stock markets, both in terms of mid and small, mid cap, and also in terms of large cap underperformance. So markets were oversold and they could be bouncing back. But my view is slightly different, and my view is that the circumstances which dragged markets down in the quarter gone by was a combination of low currency, high crude prices, fear of trade war, and then lot of redemption at PMS schemes, and also some of the HNI investors, largely because of margin requirement, they had compulsions of liquidity. Those factors may not deteriorate further. It's not that crude is going to go to $85 or there is going to be a huge concern about valuation now after the recent sell-off. So something really dire now has to happen on the liquidity front or on the global front for markets to really maintain this kind of an steep decline. So the pace of decline, I think, should get arrested. So that makes me really optimistic about where right now markets are headed, both in the month of July and also beyond July, because remember, earnings season is dawning on us, and I'm reasonably confident that the earnings season will not be that bad. You know, the peak bank provisioning is behind us. A lot of mid-cap companies, they've reported margin expansion along with their Q4 numbers. So there is reason to remain optimistic after the recent decline. I mean, this is time to buy rather than getting carried away by the obvious narrative that ye ho raha hai, wo ho raha hai. There is a problem, we know that. But now, where do we go from here? I think what we should focus on. Amit Khurana joins us. Amit Khurana, good morning. Thank you for joining us. I get a sense that you will agree with me with my assessment.
Well, yes, I think it's quite a very unique situation of the market that we've seen over the last, probably the first time I've seen over the last so many years, is where you have the Nifty, which is just about 4% 5% from the peaks, and you have the mid cap index, which is at a 1-year low, and you have stocks which are literally at 2-year lows in some of the cases. So I take your point that overall earnings trajectory is definitely supportive, and that's the reason that Nifty as such does not reflect the kind of corrections that we've seen in some of the other indices and mid caps and large. So supportive earnings season, quite supportive for exporters as well as the rupee depreciates. Some sectors definitely showing very good commentary, visibility in some of the channel checks that we have seen. But having said that, mid caps have also corrected, and therefore I would agree with your point that there may be a bounce back in the offing, but this bounce back, I would guess, will be very different, if at all, or the rally that we see from here onwards will be very different from what we saw over the last 18 months. It will not be across the board. It will be very quality specific, and it will be stock specific as we see it. So overall, we still remain neutral to slightly negative, because all said and done, India markets are still at a premium to the averages for the emerging markets, and we haven't really corrected in the entire fall. Remember, Chinese market has corrected by 23, 24 odd %, and so have other emerging markets. So to that extent, we've really held on at the Nifty level. So overall, our stance is that there will be stocks performance rather than the index performance.
Okay. Amit, have to discuss Titan with you, because after many quarters, one is seeing weak commentary coming in. The management is saying that the jewelry industry has gone through a rough patch from the month of Jan to May. They're saying that there has been a decline in bullion demand, weak consumer sentiment has hit sales, and that jewelry sales have come in below internal targets, and thereby they're going to post a muted growth. Do you think this is a one-off for Titan? And if indeed there is a dip in the stock, a significant one at that, should that be bought then?
Well, I would probably not sort of read into that as a very serious weakening of the demand per se. Remember, there's a base effect also operating. Post the demonetization and the last year transition into GST, we had a significant perk up on the volume. So part of that maybe also the base-led issue. But in general, our sense is that the footfalls are remaining to be reasonably good. If it's a question of lower conversion, we will have to wait and watch. But I would not read too much into that as a negative stance. I think it remains one of the best franchises to own for a consumption space in India. In fact, some of the other businesses than the core jewelry business, the gold business, we are finding much stronger evidence of Titan beginning to gain market share from the unorganized segment. Of course, it remains a much lower proportion of their profitability and revenue, but in general, I would definitely look out to add it on the corrections.
Right. What do you make of the opportunity in PSU banks? Amit, we've been talking about it since yesterday. Do you think that there could be a contrarian call there?
I'm sorry, that was for HDFC Bank?
No, PSU banks.
Well, extremely challenging times. I mean, really, every time one hopes that these are now value buys and things will turn around, something or the other keeps hitting them. But so our stance has been very clear. The only name that we backed up for the last so many months, in fact, quarters now, is SBI. Even that seems to be having challenges. I would sense that unless the credit growth for these names starts happening, the balance sheet growth starts happening, it's not going to really help. I mean, we can build scenarios of saying that the recoveries from the NCLT cases, some of the other recoveries will start showing up in the numbers, but that's not core profitability. So to us, these may be more like trading bounces. I know trading bounces can be sharp, 30, 40, 50% in some of the cases, and some of these names are really oversold. But structurally, one does not still have enough reasons or enough confidence to own these names. In fact, we see a bigger threat, and that is that gradually these banks will be allowed to go into a very slow decline mode and probably keep losing market share. And that gain is being made by some of the high quality NBFCs, which we prefer as a play.
Stock to look out for is going to be Tata Motors as well, and Jaguar Land Rover has been quoted as saying that a hard Brexit will cost them about £1.2 billion a year, and that could make it unprofitable. That's the word coming in from the CEO to some of the international publications. Having said that, Tata Motors has really been a non-performer in any case. But Amit, it's really the other challenges with the JLR business which I guess are going to keep Tata Motors under pressure. What do you have to say?
Well, completely agree. I think this is something that we probably also were too early to call that there is real value in the stock, and the stock has continued to underperform the broader markets. Unless you see some real evidence of JLR performance improving, and obviously the challenges on the Brexit front, which will impact the manufacturing operations quite a bit, one doesn't really, have the confidence to build up very strong positions. But if you look at the overall valuation, extremely cheap as a stock, domestic business is doing pretty good, but doesn't really contribute much to the profitability. So I guess it's a game of wait and watch, very patient. I don't see much downside from the stock valuation perspective from here onwards, but I guess the perception will keep the re-rating potential fairly constrained over the next few quarters.
Sport, Amit, how damaging is the news for Shriram Transport minority shareholders? Do you think markets made a mole out of mountain out of a mole yesterday, or there is genuine concerns which are now centered around companies' willingness to lend to a group company?
Well, I guess the statement put out, as a clarification, I think states that very clearly it's fairly well backed by a collateral of the shares. So to that extent, it addresses the issue for the near term. But I guess we're in an environment wherein slightest of the deviations from the standard policies of operating, or disclosures coming out as a surprise, tends to put people at ease, investors at unease. Considering the experience that we have over the last quarter or so from some of the real good names, the first thing that everybody wants to do is cut down on positions. So there is really no logic or objectivity sometimes to the decision making. Everybody wants to simply get out of the counters, and that leads to these kind of reactions that we've seen on this specific case as well. But I would expect that this matter should settle down sooner than later.
Well, their succession plan at HDFC Group, that's going to be, I guess, a key coffee table conversation today. In his annual letter to the shareholders, Deepak Parekh, in a very veiled manner, has said that the key focus of the group is going to be the succession plan. And in particular for HDFC Bank, with Aditya Puri's retirement in any case looming in for quite some time to come right now. The VC and CEO at HDFC, though, Keki Mistry, is going to continue for 3 years with effect from 18 November 2018. So see, he still has some time to go, but I think it's more to do with HDFC Bank, who fills into the shoes of Aditya Puri. Both internal as well as external names are being evaluated, are in the fray. That is the talk in the market. Amit, do you think for a bank as key as HDFC Bank, would it be material as to who really fills into the shoes of Aditya Puri, and would that announcement really, impact the stock price?
Well, I don't think so. This is one of the unique institutions which has been created over the last few years in the country, which really has withstood all the challenges. I think it's institutionalized to a very, very large extent. One of the best models that we've created. And I guess the biggest advantage which they have created for themselves, biggest competitive advantage, is the risk management practices that they've created internally. So it's not driven as much by the individuals. It's more driven by the policies, the internal checks and balances that they have created. So to that extent, I think it's fairly well positioned to transition into it. And I guess there is some level of visibility built into the market assumptions also as to who could likely be the next number one person. So as an institution, I don't see any challenges to that extent. And I think they've been fairly communicative of that over the last few years, that there's a process in place and they've been fairly quick at that. So I don't see an issue at all. HDFC Bank remains one of our high conviction picks. In fact, I know one of the only names that we have on banking space at large, which we've been backing up for the last few months.